Cai, good to have you in studio as always.
Thanks.
I mean, last
Good to be
week, you always come back at the most interesting of times.
Yes, I try.
I mean, last week we had a horrific market sell-off across global markets. Things were not looking so good. I mean, today everybody's awaiting inflation figures out of the US.
Yes.
What are you forecasting, and how will perhaps today's figures impact on your outlook for markets in 2018 as a whole?
Yes, well, we're forecasting that equities do better than bonds. And it is a balancing act right now between earnings growth and interest rate hikes from central banks. And the way that we see it, we see that earnings growth, profits of companies, is going to outweigh a steady rate rise. Now, the reason people look very carefully at the central bank and also at inflation is because if inflation does show signs of running away, it will not be steady rate rises, it will be steeper.
Right, so you're saying equities potentially doing better than bonds. I was speaking to some of the bonds guys, and they were saying that the spread between returns that equities give you and returns that bonds give you right now looking really thin, and you know the attraction of equities not looking so great.
Dividend yields at equities are still higher than bonds, particularly government bonds in the developed world. Now, narrower than before perhaps, but normally bonds are much higher and equities are doing the reverse. They're actually higher than bond yields right now.
Right.
So the case is still there because you get the yield, plus you get the chance at growth, versus the bond where you just have to take on interest rate risk.
Sure. So let's hone in on what the driver behind the gains in equities is going to be.
Well, that's been an interesting question and a great journey we've had, because 2017 probably marked the first year where we went from gains being driven by recovery and expansion led by stimulus from central banks. But 2017 was despite that. It was the economics driving the returns. It was economic growth, it was corporate earnings, it was employment, it was factory orders, the real economy actually driving growth. And if anything, central banks were stepping away. The US are rising rates. The money that they printed, they're taking it back. And likewise, central banks around the world are going in a similar direction, less stimulus. But still, 2017 was a marker, really, to say that economics are leading the market instead of central banks. And now we're in a world where, yes, equities can go up or down, but that's normal. I think we're at a point now where we can sort of say that the global financial crisis is 10 years ago. Now we go back to more normal markets where you can have periods where equities go up and down, and to have a correction like the one we had between January and February is something which happens every 2 years or so. And on average, it takes 3 months to recover. So at SEI, we're longer term investors. We would say stay in the markets, weather those periods, and over the longer term, you can outperform bonds.
And Cai, I imagine that Donald Trump's stimulus to corporates is also going to be a driver of companies this year.
It is, and that's seen as a positive. Earnings will now be less taxed and more put into companies' hands to redirect where to go. And it's a positive, I would say, that they put the corporation tax down from the 30s into the low 20s. But again, an interesting message that it's not the US leading this, it's the US catching up. It's significant that the US is doing it, but France is a socialist country in Europe. They've been going down from the 30s to the 20s. The UK have come down from 28 to 19. Japan are coming down. Hong Kong have halved. Across the globe, countries are dropping their corporation tax rates from the high 30s or 30 to the low 20s. So it's the US just catching up with the rest of the world here. It's a positive, but it's not trailblazing.
All right, so take us through the sectors then that are likely to do better than others.
We're still optimistic about equity markets, cautiously looking at inflation. So within that backdrop, we see cyclical sectors, so industrials, materials, so chemicals, high precision equipment, even financials doing better. Whereas the more defensive sectors like utilities, telecoms, even consumer staples, which are kind of frankly companies which are kind of bond-like, doing less well. So at SEI we're positioned in that way.
What about tech? I mean, tech companies, major gainers on Wall Street last year. What's the outlook for those guys, the FANG stocks this year?
The FANGs, yeah. We're not too heavily into that.
Twitter just made a profit.
In terms of tech, we like tech. And I think one of the drivers for inflation coming down. But in terms of valuation in the US, we're probably going to be light on technology in the US. But go to parts of emerging parts of the world, we are actually positive on technology.
So which emerging parts of the world? I imagine China?
Parts of China, but also India, Indonesia, all sorts of places. We think that the next big thing probably won't come from Silicon Valley, but will come from somewhere in the emerging world, which frankly are actually look pretty close to being developed anyway.
Sure, possibly even South Africa.
Quite likely.
I mean, let's talk about the dollar and the risk that this, or opportunity that it presents to your outlook for global equities.
Yeah, the dollar has been sliding against most of the major currencies for quite some time, particularly the euro, but also also the emerging world. And it seems to be that's the place where the country as a policy want it to be. They want to be more export-led, they want to have better trade deals, and they want the dollar to be lower. And part of Donald Trump's hire of the new head of the Fed was a guy that would support that with low, steady rate rises. Again, supporting a dollar that's able to sort of stay where it is or not go up too much.
And what about Brexit? I mean, how much of a problem are those divorce talks this year?
Politically, it's a big difficulty for the UK, and it's probably using up more bandwidth than the country as a whole would like to be spent on this, but it is a very important piece. Now, economically, either way we go through, we'll get through, and we believe it'll be fine. And our experience shows that it would be fine. But in terms of what else can be achieved during this process, it does look like things are on hold. But from a global perspective, from financial perspectives, it doesn't really move the dial as much as some investors fear.
Wow, okay, interesting to hear that coming from a person from the UK's mouth, that Brexit doesn't really move the dial. But Cai, will have to leave it there. Thanks so much. That was Cai Rees, who's a client investment strategist at SEI Investments.